Thank you very much for your time this morning, Bonga. Let's first reflect on the interest rate decision that was made on Thursday. What I found to be quite interesting was the fact that two members of the Monetary Policy Committee wanted it to be a 50 basis point hike instead of the 0.25% that we saw.
Good morning, and thank you so much for inviting us to your show today. Yes, the interest rate hike is quite an interesting one because when you look at other macroeconomic developments that are taking place, such as the oil price hike, it becomes very tricky to increase your repo rates, especially to that level, because all the input costs are rising quite steadily and quite at a fast rate because of this oil price hike. And then as your Reserve Bank, when you step in to increase the repo rate, you're adding just more pressure onto the economy and more pressure on consumers. But it's nothing surprising coming from our Reserve Bank, because they're a very conservative group of people who tend to follow neoclassical or neoliberal economic traits, which is that if during times of high inflation, you should increase the interest rate. But we've seen that just plunges consumers to further higher inflationary pressures in the short term. So it's quite a tough decision, because traditionally you'd think it should help consumers, reduce inflation in the long term. But we're about to feel the pinch now with rising oil prices and rising interest rates.
I'd argue that we're already feeling the pinch, Bonga. It's just been a very tough time for South Africans in general. But looking ahead, one big number that we always look at is the quarterly employment statistics that are going to be coming through. So just to give our viewers context here, these are the employment in the formal sector that does not include agriculture and the like. Your thoughts on what we're anticipating to see here? We saw in the third quarter we did manage to create a few jobs, but the quarter before that, the second quarter, I think over 80,000 jobs were lost in that period. What are you expecting is going to be coming out of these stats?
We're expecting nothing out of the ordinary in terms of there shouldn't be any drastic hike in jobs in South Africa. If you look at the trends, pre-even apartheid and post-apartheid, you'd see that the private sector in South Africa has no interest to create jobs, and this is reflected in even the formal sector, where you find a large number of graduates sitting at home outside of employment, simply because the private sector's absorption rate is low. And it's quite ironic, because traditionally we are told that in times of profits or in times of good times, we should see the private sector create jobs. But even in times that we saw high economic growth in the early 2000s to 2008, we experienced high growth, yet low absorption rates, and the unemployment rate was still quite high at around 30%. So even now, we still expect more or less the similar numbers. Shouldn't be a drastic change, because the private sector has time and time again proven to us that they have no interest in creating jobs in this country. They make lots of profits that they result in dividends for their shareholders and board members, but they don't result in investment, they don't result in job creation. And that has been the constant trend throughout, whether it's quarterly, annually, or even look at decades in terms of the data and the trends of the jobs, even in the formal sector. So we really don't expect much in terms of a drastic increase in people entering the employment space, even though firms have been ramping up their intakes slowly, but it should be more or less the same numbers that we're used to.
Bonga, we're also going to be getting some ABSA manufacturing PMI coming out. This is going to be an interesting one, because it's coming out after a period where we had quite a significant bout of load shedding. So one would assume that activity in the manufacturing space wasn't at all at optimal levels.
Yes, and such is the reflection of the entire, economy as a whole. Productivity has been quite low due to the sluggish response to the COVID-19 pandemic. Like you mentioned, Eskom is one of the factors as to why, production would be low. But another enabler or inaction of why productivity is low is that there's not enough government action or government support to support industries and cushion them from the blow of COVID-19. We've seen austerity across the board in terms of cutting spending, whether it's in government and on public procurement or investing in other industries. So then that makes it quite difficult for firms, even especially at SMME level, to be really productive and bounce back from the economic devastations of COVID-19. So we do expect for that index to remain relatively low and not to see so much of a drastic change like you've mentioned with Eskom, as we've seen rolling power outages. But most especially is the lack of policy support from the government through not necessarily a radical, but a fiscal expansion in government spending that will really cushion companies like SMMEs who are quite small and really need support during this time. So if we can cut the austerity and we can provide more support for industries through through a coordinated government spending program, then I think we can start to see production levels rising quite highly, especially in the short term.
And that's quite interesting because while government has instituted the austerity that you've spoken about, one big thing, or the biggest drive that they have, and it was reflected in the investment summit last week, is that they're trying to garner all of this investment from different stakeholders, both locally and globally, while trying to preserve the little that they have in terms of capital. I mean, your thoughts on the investment summit and us garnering those investments and really the sectors that they should be directed towards?
Look, I think obviously we should welcome any form of investment into our economy, whether it's domestic or foreign investment, as long as that investment results into labor-based, investments and not just capital-based. Because you must also be careful. You might be pumping in R1 billion into the South African economy, but it might not necessarily be resulting in job creation because your factors of production are largely capital and technology and things like that. So we must also try to examine what are the numbers in terms of jobs that will be created as a result of this investment. That's the first thing. And if we can establish that and see exactly the time frames as well as, okay, you're saying you want to put in R1 billion into our economy. How many jobs are you going to produce? What are the time frames for the jobs? How dignified are the salaries, and etc. But we welcome any investment. We just hope that this time will result into meaningful, real economic, tangible benefits for our people, and not just lip service that we've been hearing over the past few years. So, however, I would also encourage the states to look at domestic investment, because the problem with the South African economy at this point is that we have a large foreign ownership issue of our economy, where large assets in this country are owned internationally. Obviously, companies are listed and etc. But we should go on a drive to ramp up domestic investments, and because companies in the JSE are doing quite well in terms of profits and all sorts of things. So states should also try to lobby a large number of our domestic companies to look at investing in sectors that will result in real economic growth.
Thank you very much, Bonga Makhanya. He is the founder and chairperson of the South African Youth Economic Council, giving us a sense of what we can look forward to in the coming economic week ahead.